A shock report from a major global financial organisation is signalling more pain for millions of Australians. And if their forecasts and recommendations are correct and followed, it could end up smashing the entire Australian housing market. I'm Biko Konstantinos, and that's what we're going to talk about today. They've just released the names of a Chinese airline flight that crashed last week. The names of the pilots were Something Wong, Wei Tu Lo, and Holy Hey, if you found that joke offensive, next time I'll pay out on the bloody Greeks. Now, what's this report and what does it mean for the Australian housing market? Okay, so today we're going to look at this report from the International Monetary Fund, or the IMF, and it's their country report on Australia, which was released last week in January 2024. Now, the report's pretty long, but I'm going to focus on some of their key forecasts and recommendations, which could have a very large effect on the Australian housing market throughout 2024. Here is the IMF's shock recommendation. Monetary policy should be tightened further to ensure inflation comes back to target earlier than 2026. Now, this really is a shocking recommendation because Australia has seen some of the fastest rate hikes in history. Since COVID, when the cash rate was reduced to 0.1%, the RBA has raised interest rates by 425 basis points, taking them to their current level of 4.35%. So here the IMF is recommending for interest rates to be hiked even further. And that's because they're concerned that inflation will remain elevated for quite some time and thus take too long to return to the target inflation levels of 2 to 3%. Now, this goes completely against nearly every other forecast, which says that interest rates in Australia have peaked and we should actually be seeing a number of interest rate cuts, with some saying they could occur as early as the first half of the year. The IMF have highlighted this interesting point about Australian interest rates. Although the pace of tightening has been unprecedented, it has been less so than in some other advanced economies and at the lower end of what a naive Taylor rule would imply. Now, the Taylor rule prescribes a relatively high interest rate when actual inflation is higher than the inflation target. All of us know that the current CPI level that measures inflation does not accurately reflect the increase we've seen to the prices of goods and services across Australia. So while everyone has freaked out so far on these interest rate hikes in Australia, the IMF have shown that Australia's rate hikes have been lower than many other advanced economies. So if the IMF report is right and interest rates in Australia have to be risen even further, or even if they stay at a high level, say over 4% throughout 2024, what's the ramifications? First, more and more mortgage holders will fall into financial hardship. Most mortgage holders have now rolled over to a variable interest rate much higher than the low rate fixed term rates they were able to get during COVID. Now, most mortgage holders were able to accrue a great amount of savings because of the COVID stimulus measures, but over time those saving buffers are starting to reduce, and when they run out, it could create significant hardship for those who have large repayments. Higher interest rates will mean it will remain extremely difficult for first home buyers to get into the market. When interest rates are high, borrowing capacity is extremely reduced. This means that first home buyers can't borrow as much, and because of that, there's very strong competition for house prices in that affordable price range for first-time buyers. Now, one of the very sad things about the housing market in Australia is that many times first home buyers are getting outbid by cashed up property owners and wealthy foreigners. You see, anyone in Australia who owned a property prior to COVID has seen a massive capital gain on that property of maybe 30 to 40% just in a few years. Now, property owners who see capital gains have increased equity, which means they're able to borrow more from the bank. So they can borrow more. They've got massive amount of savings because interest rates were kept so low for so long, and easily outbid outbid someone trying to buy their first home. And on top of that, Australia allows wealthy foreigners to purchase our real estate, which just increases demand, further pushing up prices for property, making it even harder for home buyers. Now, higher interest rates greatly affect some sections of the community, but other sections aren't negatively affected at all. So higher interest rates really affect recent home buyers because their mortgages are so high and their repayments are going to be massive. But like we mentioned, they also affect first home buyers, but on top of this, they affect renters. And that's because property investors are passing on their increased interest costs over to the renter. And this is extremely bad news for renters in Australia because they've basically been screwed from all angles. They receive absolutely no benefit from COVID stimulus measures sending house prices through the roof, and now they're paying the price with soaring cost of living expenses combined with crazy surges in rent prices. And on top of that, some of the lowest rental vacancies in history. This situation is an absolute fustercluck for renters. The IMF report highlights that rents used to average a 2.1% increase per year in the decade up to January 2020. But since COVID, they've been rising around 10% per year, and in some places way more than that. Now, because of these financial pressures and the difficulty of first home buyers getting into the market, it can be assumed that the government will keep trying to come out with new schemes to try to help them buy their first home. Whether it's some sort of first home buyer grant, reduced deposit requirement, or a co-ownership arrangement with the actual government, they're pretty much guaranteed to keep coming out with these schemes to look like they're helping first home buyers. The trouble is, all these schemes end up doing is increasing demand for housing, which means property prices end up rising even further. And then we've got the effect of these higher interest rates on businesses. And there's two main ways that this occurs. First, businesses who have loans have to pay higher interest rates, and this means that their expenses are increased. And secondly, higher interest rates for longer periods ends up putting more of the population into financial hardship, and this means they start getting tighter with their money and consumer spending is reduced. When that happens, there's less money going to businesses, which means their revenue and profits are reduced. And when businesses have higher expenses and reduced revenue, that's when they start cutting costs, and one of the fastest ways they do this is by laying off staff. So throughout 2024, we can expect increased layoffs, which will start increasing the unemployment level. Now, in my opinion, the unemployment level will be the biggest factor which will impact house prices over 2024. Because at the moment, when we have full employment and people can get second jobs if needed, there's not too many homeowners or property investors that currently are being forced to sell their properties. But if we were to see a sharp increase in unemployment, then forced sales would definitely increase, and that would put significant downward pressure on house prices. So there you have it. The IMF recommends higher interest rates in Australia, and they also don't think we'll have any interest rate cuts during 2024. And if that's the case, the Australian housing market could just end up getting smashed. I'm Biko Konstantinos.